All right, well, welcome everyone to today's market update, our sixth in a recurring series. This is our June update, and we will not have one for July, but we do have one for today, and we're happy you've joined us. My name is Greg Patterson, and I'm joined with my teammates, J.A. Kennedy and Tara Gould, and we are with Atlantic Wealth Management here in Morehead City. And we're glad you've made time to be on the line today. And we hope that these virtual meetings, these webinars are useful for you and your family and your loved ones. There's a lot going on out there in the headlines, so we hope to bring some of that just down in a format that's easy to understand and can share our thoughts and give you some of the highlights of the headlines. As in past broadcasts, we hope these can be useful for you to share with your friends and family, your loved ones. We do take about a week approximately to get our compliance team to update them, and then we can save them down on our website for you. And I would just ask, if it's useful, you can forward those along to those you care about. If you do have questions or you have anything come up that you think we should know about, by all means, send us an email. We like to route those through Mackenzie here at our office. And so let me give you her email. It is mackenzie@myatlanticwealth.com, and you spell her name Mackenzie. You're always welcome to call us too at 515-7800. We always appreciate your questions and look forward to any feedback that you can give to us related to these webinars or anything else that comes up. So we will be back on August 28th. That's the fourth Monday in August. It will be after our annual client event. So we hope to see you guys there. You should have gotten a save the date notice on that. And we'll be forthcoming in an invitation to you as well. But July economic news tends to be a little light, so we're going to skip that month and be back with you in August. So with that, I know we've got a lot to cover, so let's look over the agenda for today. It looks similar to what we've done in the past with looking at current market returns. Tara does a great job at bringing these to you, both from a year-to-date perspective, but also looking over the past year and 5 years. We also want to look over the latest economic data and give you those news releases and share what's going on in the economy. We'll talk about the U.S. Recession Risk Indicators Dashboard and share our thoughts on that. And then we want to look over the LEI, the Leading Economic Index, which is put out by the Conference Board. And then we're going to talk about something that's really important, which is the CPI and PPI trends. Consumer Price Index is that inflation gauge that we've been watching closely. And then we're going to bring a special topic to you with education funding and learn about this, as well as give you our conclusions and thoughts, some action items that you can take away from this meeting. So that's a whole, that's probably an hour full. We're going to try to get it done in 45 minutes and send you guys on your way. It looks like a beautiful day outside. And
35 minutes.
35, yeah. So we hope you can enjoy the rest of your afternoon. And with that, Tara, I'm going to turn it over to you so you can bring us up to speed on what the markets are up to. It looks like they were down today, but I know it's just one day. Give us some perspective on this.
Absolutely. Love to talk about the markets. And so the first chart that we're going to go through is S&P 500. If you guys have been with us for a while, we do like to quote S&P 500 because it is a very good gauge, if not the best gauge, of the U.S. equities market. And so the first chart we're looking at is year to date. So this would be January 1st through the 26th. So through earlier today, we still have a low in year to date that occurred on Thursday, January 5th, and that was around 3,800. I am happy to report, glad you can see that we're now trading over 4,300. And we started the year around 3,800. And so what that looks like from January, beginning of the year to now, is the S&P 500 is up 13.5%, which is a, a nice jump. The next one we're going to look at, here we go, is the 1 year. And so just to highlight a few things, the 52-week high from this standpoint is 4,448.47. That was actually hit back in August. And then the low of this year outlook was in October at 34.91. So as I previously mentioned, we are currently trading above 4,300. And so from that October low, the index is up quite significantly. And you can see from that 1 year standpoint, it's up 11.34%, which we are glad to see positive numbers now, because we were running negative numbers for the 1 year for a while. So this is a delight to see. And then the next chart we'll look at is taking a step back, looking at a wider view. This is the S&P 500 over 5 years. And so you can see that sharp decline. You probably remember those days back in March of 2020. The index actually dipped down into the 2,300 range. And then, of course, we had some higher trading that followed through the next year in 2021, actually topped out December of 2021. We were seeing trading at over 4,700, and that transferred or transitioned a little into January. From this perspective, it just shows you that we've had, quite some volatility, but also we're not quite back to where we were as far as the highs at the end of 2021. We still have a little bit of room here. Next, we have NASDAQ. And so the first one is the NASDAQ year-to-date chart. NASDAQ is another staple of our markets and indexes that we look at. This is comprised of 3,700 companies, very heavy in tech. And so that's why you've seen that dramatic increase in NASDAQ. So for NASDAQ, we had a year low on January 5th. That was around 10,300. And we're looking close to a high now, just maybe a few days ago. And so the year-to-date increase on the NASDAQ is ranging between 28 and 29%. It's pretty significant. And then we take a look at the 1 year. So again, each time just taking a step back, it provides some perspective when looking at these charts. The 52-week high was at 13,864. And that was actually really recently in June or earlier this month. For the low from this 1 year perspective was down around 10,000 or trading a little over 10,000. And so since that low to where we went at the high point, that index increase has been around 27%, which is pretty in line with the year to date. And then we have one more to take a look at for NASDAQ. And again, taking a step back and looking at that 5-year view just gives us a perspective of this journey that we've been on together. So for the past 5 years, the NASDAQ index is up over 78%. As similar with the S&P 500 index as of December 31st. We saw high point range, and then you can see that we are a few points off of that. To be a little bit more specific, around 17% or around 2,700 points until we get back to that December 31st high.
It's always helpful to go take a step back and look, not just over the last 12 months or even year and a half or 2 years, but to see, longer term trends in the market, which we would expect to continue as we go forward as well.
Right.
All right. Good afternoon, everybody. We have just started highlighting headlines of the week, which actually in this case goes back week before last. not to last week, but 2 weeks ago. But just wanted to, we did have major news. It was a big news week, week before last. And so the first piece of news that came out on Tuesday of that week was just inflation, and the latest number with inflation coming in at 4% year over year, measured by the CPI through May. And the headline there, the lowest in 2 years. So we've continued to see inflation come down slowly, and we'll take a look at a little more detail around that in a minute. That was followed the next day by the Fed with their announcement that they were holding off on interest rate hikes for their meeting this month. But it was a little bit out of the norm in that they suggested that there may be 2 more hikes coming later in the year, and potentially another 50 basis points. Some folks have, commented that if the Fed was going to, if they're thinking they're going to continue to increase rates, why wouldn't they go ahead and do it? Let's take our medicine and deal with, the fallout of it. But I think what the Fed is saying is they wanted to stop and give it a little bit of time. Hopefully is saying that they're going to continue to watch and be cognizant of the economic news that comes out between now and their next meeting. And it does give them some flexibility, I think, going forward to either hang tight where we are or to increase. So I think, it does set the expectations for the market that they may very well not be done. But I think that bodes well for if they are done, or if they only, go 25 basis points versus 50, provides an opportunity for some market upside, as opposed to the other way with the Fed saying they're done and then reversing course. So we will see what happens as we move forward, but that was the latest announcement from the Fed. And then what we saw a week before last was the markets really liked that. They liked the inflation being a lower number. And I think even with the comments around the Fed increasing rates, there was some certainty around, we're at the latter stages. And even if we go up another 50 basis points last week in the market, they kind of gave back the gains of the previous week. So maybe that was a little bit of that was potentially digesting further that news of the fact that the Fed could continue to have another couple hikes in their pocket potentially. But what is all that, we've talked a lot about consumer price index, inflation. This is one of the major ways that we measure inflation, and it is based on the cost of goods at the consumer level. And so this chart, I think, picture is worth 1,000 words. So going back to May of last year and into June, we topped out on the CPI at 9.1%. But you can see a pretty solid trend that's been laid out since that time. We've continued to slowly come down, and this latest reading 2 weeks ago was 4%. So that's all positive, right? Coming from 9.1% down to 4%. If we were to backtrack, nobody predicted that we were going to get as high as 9% on CPI, but we did, and we've made progress in bringing that number down. Where are we headed from this point? Just looking further into the details around CPI, this chart shows the monthly gains in the CPI from month to month. So this actually goes back 13 months. And one of the reasons why we dropped down from 4.9% to 4% in this last reading was, if you look back to May of last year, this was a very big monthly. It was almost 1% increase just from one month to the next. That number dropped off with a year over year, the 12-month year over year number on the CPI. So that allowed it to drop down to 4%. This next reading that will come out second week in July, we will see this big June number, the 1.2% just for the month of June, that will drop off. So then you're left with kind of these much lower month to month readings. And based on that, we would expect and hope that, the number for CPI next month would drop into the threes. The Fed has said it still has a target of 2%. So the question would be, how long does it take us to get from where we are now down to 2%? And nobody knows exactly the answer to that question. We continue to maintain watch over the CPI and other things like the PPI, which the PPI is the producer price index. Similar to goods at the consumer level, this index measures goods at the wholesale level or the producer level. And this shows an even more substantial trend and change. We kind of look at it as a leading index for the CPI. If you think about producer prices, if the producer is saving on their input costs, ultimately that's going to flow through to the consumer. And so if you look here at the top of this chart, this was March of 2022, March of last year. The number for PPI topped out at about 11.7%, and it's come down dramatically. This last reading, week before last, was 1.1% on the PPI. So that's another good indication that the trend has been set on the CPI, and hopefully we'll continue to see that come down.
It's hard though, isn't it, when you get into inflationary, especially higher inflationary times, because the producers are raising their prices to try to anticipate what might be happening in the future without really knowing it. And thus, I mean, we've talked among our team with companies raising prices well above the 4% number.
Yeah, and a big input cost too is labor, and we have seen wages rise and because of the tight labor market. So
yeah,
that's been another variable to the equation.
I went and Saturday, it seems like I spend a lot of time in Lowe's Home Improvement. I bought some Romex 12-2 electrical wire. 50 feet cost over $80, and that price has steadily increased over time. Only difference was it was in a locked cage with all the other electrical wire, and that hasn't been the case. They did have the bigger bulk wire in locked cage prior, but this time, just even 25, 50-foot sections are in a locked cage, which tells me maybe not locally in our store, but certainly some stores have been dealing with theft of those higher priced items like that.
Times are different, aren't they? I'm just going to hit the high points on these next bullet points, with regards to economic data since our last webinar. Employment report that came out at the beginning of this month. Inflation not inflation. I've got inflation on my brain, but unemployment jumped up a little bit from 3.4% to 3.7%. And we have seen initial jobless claims tick up slightly. I think the latest weekly number was in the 260,000 job range, and the 4-week moving average has jumped up over 250,000 for the first time. So that's kind of we've been paying attention to those initial jobless claims as being leading indicators to where we are headed from a unemployment standpoint. So with the uptick this past month, we'll continue to maintain watch over that as we go forward. The housing market, obviously interest rates have impacted the housing market. And so we have seen, home sales decline in terms of numbers. So existing home sales are down about 20% year over year. Interestingly enough, though, we have seen the median home price increase over the last few months. So it's increased over the last few months, but overall, this is nationwide. The median average median home price is down a little over 3% year over year. So from 12 months ago. One positive area of the housing market is housing starts, which are up from a year ago. So up just a little less than 6% over a year ago for housing starts. So we think that is a good sign. I think, you know, the Great Recession, where real estate was a big leader or cause of that, or big, if we go back into what was at the heart of the last Great Recession, we don't foresee that this go around, because there hasn't been a major overbuilding of homes for the population as it stands now. So we see that as in those new home sales numbers, or excuse me, the new housing starts number. Retail sales, we have continued to see the consumer spend in general, and there's been a resilience there, which again has kept a lot of these numbers for the overall economy in a positive direction. They're not tracking in line with the rate of inflation like they were at one point last year. Retail sales were up 1.6% year over year, whereas inflation is tracking at 4%. So we have seen those two numbers diverge a little bit. Industrial production, we had seen positives in industrial production to start 2023. We did drop back. The monthly number declined a little bit this past month. So we'll continue to maintain watch over that. And then gross domestic product, that just is a measure of economic output. And the first quarter, we had the second estimate for the first quarter come out at the end of last month. The annualized number, they increased that from 1.1% to 1.3%. So we would say 1.3% annualized growth is on the lower end of things, but they did revise it up, and we've got a final revision that will come out later this week on Thursday. As far as we're tracking towards almost finished up with the second quarter, so it'll be another 30 days plus before we get a first estimate on that. But the forecasts are that we are going to be higher for the second quarter than the first quarter in terms of economic growth, which is a positive, and also brings us back to, as we look at recession indicators and things like that, we're not in a recession yet. So we'll have to continue to maintain watch over all these bullet points here as we go forward. The Fed, we've kind of talked about already, so I'm going to let Greg jump in on recession risk indicators.
Yeah, thank you, J.A. So the last change in the recession risk indicators dashboard, which is put out by ClearBridge, it's part of Franklin Templeton Investments. This change happened in March with the housing permits moving from yellow to red. And then, of course, there is no change in the dashboard for May, for the end of the month. So the signal is still red and has been so for quite some time. The first signal of the dashboard to turn from yellow then to red was wage growth. And Jay mentioned this. This happened back in 2021, but it really is sort of, we're looking at this as the canary in the coal mine with the initial jobless claims. This is signaling weakness despite the strong headline numbers in unemployment. But what we're starting to see now is higher income cohorts have increasingly been filing claims, which is, it's an atypical shift that really we would expect to have a bigger drop in consumption towards the back half of the year. So we're keeping an eye on that. We think that the new job creation is a strong indicator, but we don't want to lose sight of what's happening beneath or behind the scenes, rather, with those initial claims. So the dashboard is certainly a way that we can track this. And as we've mentioned in previous webinars, we see that the consensus among economists has probably never been greater for a recession, although there is sort of this range between economists of those that are bullish on the economy and those that are bearish. Of course, I don't think anybody's extremely bullish, but the degree to which they are concerned about the economy varies. And then if you look at a longer term perspective on this trend, basically what you're looking at here from left going back to right is the previous recessions and what that dashboard looked like across those different areas that we track. So some of them still had green in them. The most recent one was 2020 with COVID. And of course, the onset of COVID dropped markets rather quickly. And that recession, as it was called, still had a lot of expansionary ingredients to that, most notably the money supply increasing. So I think we're all feeling the impact of that, what you guys say, as it relates to inflation and the other challenges of that. So I think overall, we would still say that the signal is red and an X on that. Truck shipments and jobless claims are still the holdouts on yellow, although we are, as Jay had mentioned, we are seeing upticks in those weekly numbers too. Let's take a look at the LEI, the leading indicators. This is put out by the Conference Board, which is a member-driven think tank. It's a nonprofit, nonpartisan group of members that get together and update leading economic indicators every month. So this one, you can see to the far right, the blue line is the year-over-year change. And those numbers were updated most recently last Thursday. So it's a pretty current look. It's down 4.3% over the 6-month period between November and May, which is a steeper decline than the 3.8% contraction, which we saw over the previous 6 months from May to November. It really is continuing to fall primarily as a result of deterioration in the gauges of consumer expectations for business conditions. This is the ISM New Orders Index. They're also concerned about a negative yield spread and worsening credit conditions. So that's the reason for the drop. The Conference Board has put an update out that they've revised their second quarter GDP forecast from negative to slight growth. And even in spite of that, they projected the US economy will contract over Q3 to Q1 next year. And they would anticipate that the recession would likely be due to continued tightness from the Fed with the monetary policy, as well as drawback in consumer spending, if you can believe that. I don't know how much the government would be able to cut back in their spending, but that's the word from our folks at the Conference Board. Nonetheless, if you look at the gray bars going back to 2001 that you see, the vertical gray bars, you can see that one in 2001. That's the length of the recession. And then, of course, 2008, as you move to the right of that, was the great financial crisis. And then the skinny bar over to the far right was COVID. The blue bar tends, or the blue line moving left to right, tends to anticipate that recession, as it has for this time period as well. And the gray line would represent the change in real GDP, gross domestic product.
I think we've talked about this before, but it's worth noting again that if we look back a year ago, we were talking about maybe recession the first part of, first quarter of 2023, and then it seems like it just keeps getting pushed, further and further back. So But as you look back, I mean, we really have had a pretty resilient economy to this point, with consumer spending continuing, unemployment remaining low in the midst of going from 0% on Fed funds rate to 5%. So just a huge jump in a short period of time. Um, but we're still looking at a positive second quarter. So yes, these things we may see these things deteriorate and have us dip into recession as we go forward. But I think it's also telling that nobody, if we look back, especially over the last 18 to 24 months, for somebody that like called these things right, it's very difficult. And I think even more so today than in previous periods of history, to try to go and predict exactly what's going to happen over the next 2 or 3 months or 6 months even. It's just difficult. We don't have a historical precedence to go back to when we dump trillions of dollars into the economy and we're able to see what happens. We're just learning as we go.
Yeah, the Fed's really been aggressive at raising the interest rate. It's been their benchmark rate's the highest it's been in 16 years. So that's definitely going to have an impact. It has thus far and will continue to. It is bringing down inflation, and we would expect that to continue. The July report comes out on the 12th at 8:30, so it'll be interesting to see that release. Those are the two headwinds that clients have been facing. But also you have to keep in mind that if you were to have got out of the market last year, you probably would have done so in the later half of the year, fed up with the returns in your investment portfolio, and you'd have missed the returns that you've seen just this part of the year, this half of the year, as Tara went over. So it is important to realize these cycles do happen. We don't necessarily know when they're going to happen, or we can't predict them with pinpoint accuracy, but they do happen. It is part of a normal cycle of things, and a recession is part of the economic and business cycle. So at the end of the day, let's be diversified. Don't get out of the market if if your risk tolerance is such, and you can benefit from those returns even in spite of some indicators that may lead you the opposite direction. Which is a good segue, I think, to the next point. We were talking about what should we name the slide? What is your cash earning? I think is appropriate. We all, have cash on the sidelines that we think should be earmarked for reserve or vacation or emergency or any sort of number of things, short-term goals, right? And so it's important to take a look at that, because $50,000 in your bank earning 0.10, which might even be generous, right, you guys? It's going to earn you $50 a year in interest. And a money market fund that we have access to is earning 4.7. That's $2,350. So it's a benefit of $2,300 just on cash. So I think the takeaway is, and what we want you to pull away from this is, check the cash, the interest that you're earning on your cash. And if you're with one of the bigger banks, our guess is that you're probably under 1%, maybe even closer to that 0.10 or 0.01, as I recently discovered. And go have a talk with your bank, or better yet, if you've got some that you'd like to move to the 4.7% rate that we have, send us an email, give us a call, and take advantage of that. It's meaningful just from the real dollars that you would receive from that, and really not increasing your risk tolerance at all. It's a very simple way that you can help with that interest earnings.
Absolutely. We're going to shift gears here. If you've been with us for the past couple months, we've been highlighting different financial planning topics, topics that are of interest, hopefully, to you, and also of importance. We talk about these things collectively and also what's impacting our clients, and just want to provide a broad overview of that. So this month's focus is education funding topics. We could easily do an entire webinar on each of these, but wanted to give you some things to think about and ask that you reach out if any of these impact you. And so the first that we'll start with is just some funding education options. And I generally ask the question to clients of how do you want to help, or what do you want to help with? If the answer is I want to assist in paying for college, then that directs our conversation to start with 529 plans. We would first start off with that. So just a little background on 529 plans. There are tax benefits for putting money inside of these plans. So it is after tax dollars that you're contributing. But when the withdrawals happen, if they're used for qualified educational expenses, that's where your tax benefits are. And so the idea is you're starting very early on in the child's life. They do need to be born first. Somebody's asked me that question before. There are, I guess, some unique ways we could get around that. But if you're going to open 529 for benefit of someone specific, they do need to have a birth date. And you're funding this, it is going to be in line, the investments. So your money goes in after tax. We're able to select different investments that are in line with when the child is going to go to college. And then once they get college age, you start withdrawing that money for those qualified education expenses. Most recently, this has been over the past few years, 529 plans have expanded to be able to use for K through 12 expenses, some apprenticeship programs, as well as any student loan repayment. So there might be some opportunities there. The most common of the 529 plans is called a college savings plan. I explained that earlier, which is where you're using after tax dollars and then getting a tax benefit as you withdraw. So this is on the federal side, but also note that some states do have tax benefits and also credits for contributions. Another funding option that some people do not think about is a Roth IRA. Now, this would be a situation in which there are sufficient retirement assets for you already, but you want to look at other opportunities. Where can I set money aside? I still want growth on it, but I want some flexibility. Maybe I do want to take money out, maybe not. So Roth IRA is a good option because you can put in your after-tax contributions. Those are going to compound and grow. So the compound and growth on that is going to be your earnings, but you can take out what you put in because you've already paid taxes on that. And so you can withdraw those contributions tax-free, and maybe you want to set those funds aside for college expenses. Only the contributions though, and not the earnings if this is before your age 59 and a half. We have some clients who want to use a taxable account. So whether it's an individual taxable account, this would be in your name, or a joint taxable account. This gives you probably maximum flexibility. You can put money into this account, can be invested according to maybe specifically when that goal is that you want to gift money. In a taxable account, it is after tax dollars. You do have to pay taxes on dividends and then also those capital gains. But there's no limits on how much you can put in or be able to withdraw. And so we've had some clients come in and say, yeah, I know I want to gift something to my, my child, my grandchild around college age. This is a good way to do that. Another one I'll mention here before I move on is something called an UTMA or UGMA. These are minor or custodial accounts. I would say not the best for specifically college, but if you wanted something with some flexibility and you wanted your child to choose, because with those minor custodial accounts, the way it works is once that child reaches the age of majority those funds are theirs, and then they can choose what to do with that. So those are just a few ideas. I would say if this is something that you're thinking about or interested in, contact us, let us talk through all of the available options and then decide on a direction. One thing I did want to highlight, because it's exciting, anytime there are changes, especially changes at the benefit of investors, those are exciting to share. And so in 2024, this is part of Secure Act 2.0, and you're going to see different things start to trickle out. So this year, you maybe heard that the R&D age, required minimum distribution age, has increased. That's part of Secure 2.0. There's a lot of laws that are changing, but one of them surrounding education is 529 plans being flexible to pay out to a Roth IRA in that beneficiary's name. So there are, of course, going to be some restrictions around that. Whereas before, but I want to bring it up, I want to talk about it. Whereas before, if you put money into a 529 plan, you could then transfer that to maybe another family member. But if that wasn't the case and you decided you wanted to withdraw the money, there were taxes and penalties associated with it. So this new law allows you to 529 funds up to the maximum limit for whatever that year is for Roth IRA funding, to be able to transfer that into a Roth IRA for the beneficiary. So again, exciting fun things to talk about. And then last here is student loan repayments. Maybe it's not directly you, but you have a friend, a family member, you have someone who does have federal student loans. Now is the time that you're going to have to start paying those back. And so I don't know if you realized it, we were talking about it and really couldn't believe that it's been 3 years since the federal government says we're going to pause on student loan repayments. Interest rates are going to go to zero. Starting in September, that is all starting back up, and then the first payments are going to be due in October. So if you have you yourself, children, grandchildren who want to talk through those student loan repayment options and what's the best way in order to approach that, please have them contact us and we'll be glad to have that conversation.
Great. Thank you, Tara.
Of course.
And that brings us to how we kind of like to wrap these webinars up, which is just to share and impart just some biblical wisdom and truth from God's word. And so these few verses are from Hebrews chapter 4, and we read, since then we have a great high priest who has passed through the heavens, Jesus, the Son of God. Let us hold fast our confession. For we do not have a high priest who is unable to sympathize with our weaknesses, but one who in every respect has been tempted as we are, yet without sin. Let us then with confidence draw near to the throne of grace, that we may receive mercy and find grace to help in time of need. And so there is a place where we can go to receive mercy and find grace to help in time of need, and we can draw confidently to our Lord and Savior Jesus Christ, who is our mediator and who is our high priest, who can sympathize with us having walked on this earth himself. And so we would just encourage you in that. Yeah, this is where we go to for mercy and grace and wisdom. And so if that's something you'd like to talk to us about, we'd be happy to do that. And with that, just want to wrap up. In closing, if any of you have cash, as Greg talked about, cash that you'd like to maximize return on, but still keep low risk scenario, please reach out to us. Let us know, or if you know of others that may be in that situation. Similarly, if there are any of the topics around education funding that Tara mentioned that would apply to you for children or grandchildren, we'd be happy to have a further more in-depth conversation with you around your specific situation. But as Greg mentioned to start the webinar too, if you have friends or family, neighbors, co-workers who you think would benefit from just this market update and the topics we talked about, there will be an opportunity for you to forward this along. We do post these monthly webinars on our website, so you can go back and view if you're not able to catch them live. And so we would just remind you of that. And then, as Greg said, we won't be doing one of these in July, so we will catch you guys back in August. Lastly, we are here just to serve you guys and to be a resource to guide and advise. And so please don't hesitate whenever you have anything that comes to mind from a question or concern or just needing to talk through something. That's what we're here for. And so we hope you will reach out to us for anything like that. I guess we will wrap up with that, but we hope you guys have a good rest of the summer over the next few weeks before we have another one of these calls, and we will look forward to our next call or meeting with you guys. So thank you, take care, and God bless.
See y'all.
Bye.